Welcome to the Tax Mistake 1.5 lakh. This video analyzes why the new default tax regime isn't a universal win for all salaried Indians in the FY 2026-27. The quiet default switch is a critical financial crossroads. The new tax regime is now automatically applied, which can be an expensive error before the March 31st deadline for those who benefit from the old regime. As one CA stated, following the herd could cost you over 1.5 lakh in unnecessary taxes. The core conflict is a binary choice: low tax rates with a zero tax threshold up to 12.75 lakh, or high exemptions from things like HRA, ADC, and home loans. You can no longer have both, forcing a choice between the new frictionless low-rate system and the old complex high-reward exemption system. Looking at the structural differences, the new regime eliminates most traditional deductions, like Section ADC, HRA, and home loan interest, in exchange for a higher tax-free threshold and a $60,000 special rebate. The old regime retains these deductions, but has a steeper slab progression. The mathematical tipping point shows that if your total combined deductions exceed 4.5 lakh, opting out of the default new regime is financially mandatory. The area to the left favors the new regime, while the area to the right favors the old regime. We explore a tale of two earners, both with identical 18 lakh salaries: the minimalist with simple finances and the optimizer, a homeowner, high rent payer, and aggressive investor. Their outcomes demonstrate how different tax choices can be. Case study 1, the minimalist. With minimal deductions of 1.5 lakh, the new regime tax liability of 16 lakh is lower than the old regime 16 lakh, which results in savings of 85,000. For this profile, low rates easily beat minimal exemptions. Case study 2, the optimizer. This earner has substantial deductions of 5.5 lakh from a home loan and high rent. While the new regime tax liability is 16 lakh, the old regime is cheaper and saves 40,000. The default switch would actively harm this earner. The geographic multiplier is key. Recent government tweaks expanded the 50% HRA bracket to tech hubs like Pune and Bengaluru. For professionals paying premium metro rent, this massive deduction potential gives the old regime a powerful new lease on life. Your decision framework involves 2 steps. Step 1, assess your lifestyle. Are you paying high metro rent, carrying a home loan, or utilizing ADC/ADD? Step 2, calculate your threshold. If your deductions are less than 4.25 lakh, do nothing. If they exceed 4.5 lakh, opt out and file under the old regime. Ultimately, if you aren't running your numbers through a 2026 calculator this week, you're just guessing with your savings. Calculate your exact deductions before the March 31st deadline. Do not accept the default without doing the math, and consult a chartered accountant for your FY 2026-27 strategy.